Hello everyone, welcome to another video. Today we are going to talk about bonds payable subsequent measurement for issuer. Like if you want to report your bonds in balance sheet at the balance sheet date, so how can we present the bonds in balance sheet? So here we have a balance sheet presentation. Okay. So first of all, you will write here total face value of the bonds. Then you will add here unamortized premium. Okay, unamortized premium mean to say we need a total amount of premium less accumulated amortization of premium. This is how you will get unamortized premium. Less unamortized discount. Unamortized discount, again, we need a total value of discount minus accumulated amortization. This is how you will get. Third item which we need to subtract, that is called unamortized debt issue cost, which you can calculate this way. We need issue cost minus accumulated amortization of that issue cost. So this is how you will get carrying amount of the bonds in balance sheet. In the last video, we have already talked about how to amortize the premium. So in this video, we are going to talk about how to amortize the discount. And in the next video, I will talk about how to amortize the debt issue cost. So here we have here income statement presentation. If you want to present the bonds and relevant expense in the income statement, this is how we can calculate. We need interest paid at stated rate. Actually, stated rate mean to say the rate of interest which is mentioned on the bonds, and this is actually the cash payments to the investors as in shape of interest. Then here you will subtract amortization of premium for the period, and we use amortization schedule to amortize the premium, and the premium for the period you will subtract here. Then we will add amortization of discount. This is what we are going to talk about today, how to amortize the discount and how it will affect income statement or balance sheet. Here you might have also one more extra item I can just add. So you can here also might have debt issue cost. Okay, amortization of debt issue cost. So this could be also the part of finance cost, if any, like if you have any debt issue cost. So this is how you will get the interest expense, which will be equal to interest expense at effective rate. Okay. Effective rate means to say the rate of interest which is prevailing in the market at the time of issuance of bonds. So how we will deal with the discount or amortization of discount. So to deal with discount or amortization of discount, we always use effective interest method of amortization. Either you have a premium or you have a discount. So you can use effective interest method to amortize the amount of premium or discount. So under this method, what we need to do, we will prepare amortization schedule. But before moving to the amortization schedule, let me just give you a few concept. So here we have here annual interest expense. If you want to calculate interest expense for the income statement, so usually how we can calculate carrying amount multiplied by effective rate of interest. If you will multiply, you will get annual interest expense, and which will be equal to this value. Okay, and this value you can also calculate by using this format. Okay, we can take interest paid at stated rate, less amortization of premium, add amortization of discount, add amortization of debt issue cost. So this will always be equal to effective interest expense. Okay. So here we can also calculate this way also. In short, we need a carrying amount times effective interest rate. Second thing, if you want to calculate cash interest payments, which you will actually make payments to the investors, so we need always a face amount multiplied by stated rate. Okay. Face amount mean to say it is a value of the bond which is written on the bonds multiply by stated rate. The rate, it is also called coupon rate. If you will multiply, you will get cash interest paid. Don't forget the difference between cash interest paid and annual interest expense is always amortization of discount or amortization of premium. Okay, so here we go how we can work. Let's have a look with the help of example. So first of all, we have here on January 1 year 1, Dizzler company issues 206%, 5 years, 5,000 bonds when the prevailing interest rate in the market is 8%. Actually, here we have a number of bonds 200. We have 6% is the stated rate and 5 years is the maturity period. This 5,000 is the face value of the bond. So here we go. First of all, we need to understand, should we issue the bonds at par or premium or discount? So we can take very quick decision by comparing the market rate with the stated rate. You can see here market rate is 8% and stated rate is 6%. By the way, I have already covered in the previous video, but let me just quickly repeat for you. If your stated rate, which is 6%, is equal to market rate, so it means bonds will be issued at par. If your stated rate is greater than market rate, bonds will be issued at premium. If your stated rate is less than market, so bonds will be issued at discount. So here our stated rate is less than market, so that is why bonds should be issued at discount. Okay, so how you will calculate the amount of premium or discount? For that, you need to calculate the present value of face amount plus present value of cash interest. So once you will make the summation of these two present value, which is equal to cash proceed, you will compare with the face value of the bonds. Okay. If the present values are greater than face value, so it is amount of premium. If present values are smaller than face value, it is amount of discount. Okay, so here we go how we will calculate the present value. I can just here summarize for you guys because I have covered in the other video. So I'm assuming here you have idea about time value of money. So here we go. First, we need to calculate the present value of face amount, because here we are going to calculate the present value of cash associated cash flows associated with the bonds. And here we have a two cash flows, which as a company we will pay to the investor. One is interest and second is the face value. So we are going to calculate the present value of face value and interest. Okay, this is how you will calculate. So we have here present value of face amount. Face amount is 1 million. How you can calculate this 1 million? Because you have 200 number of bonds multiplied by 5,000 face value for each bond. If you will multiply these two value, you will get face value. Okay, face value will always be multiplied with the present value factor at market rate. Don't forget. Okay, so your market rate is 8% because we are using effective method, effective interest method. Okay, so market rate is 8%. So what I can do here, if I want to find this present value factor, I need to move to the present value of $1 table. You can look at here. I will go for 8%. This is the 8% because market rate is 8% and bond is having a maturity of 5 years. Here years are mentioned. You can look at here year 5. In row of year 5, I will just look below the 8%. So here is value 0.681. So let's move back. So here we have the value of 0.68058 because their values are written up to 3 decimals. So if you will multiply these two values, you will get the present value. Now you have to calculate the present value of interest. So first we need to calculate the amount of interest per annum. How can we calculate? Simply we need a face value which is 1 million multiplied by stated rate. Don't forget because this is the actual interest which we will pay. So 1 million times 6%, this will give you interest per annum 60,000. So I will put it here 60,000 interest per annum multiplied by annuity factor. Because if you have idea about time value of money, whenever cash flows are constant for defined time period, we can use annuity factor to calculate quick present value. So here we go. Annuity factor we can take from this table. You can look at here, it's having a name of present value of ordinary annuity. Again, I will go for 8% and I will look in front of 5 years. Okay. So value is 3.993. Okay. This is the annuity factor. So now let's go back. So here we have a 3.99271 because again, their values are written up to 3 decimals. If you will multiply these two values, you will get the present value of interest also. Okay. This is the rounded value. Now what we will do, we will make a summation of present value of face plus present value of interest. It is equal to cash proceed, which is $920,146. So simply now you will compare this present values with the face value, and face value is 1 million. If your present values are greater than face, it is premium. If your present values are less than face, it is a discount. And here you can see your present values are less than face. Okay, so it means difference is a discount. So what entry we will pass now? So to record this transaction at the date of issuance, what we need to do, we will make debit cash always with the present value of cash flows, which is 921.64. Credit will go to bonds payable always with the face value. Now you can see there is a difference, and the difference is the discount on bonds payable, which is the difference, which is 79,854. And this discount we will amortize over the bonds period by using effective interest rate method. And how it will work, let's have a look with the help of example. The same example we are going to continue. So here, first of all, the first column we will write here years, because this discount you are gonna do amortize over the 5 years. So then you will write here beginning carrying amount of the liability. Then you will multiply with effective rate. Don't forget it is effective rate, market rate. Okay. Then it will equal to interest expense, which you will record in the income statement. Then you will subtract your minus cash payments, which you are going to pay interest. Okay, you are going to pay interest over the bonds period. And then it's equal discount amortization. Like if you will take the difference of interest expense and cash paid, this is called discount amortized. Okay, and then we have an ending carrying value. Ending carrying value, how you can calculate? You need beginning carrying value plus amortization of discount. So it will be equal to ending carrying value. So here we go. So first of all, we will start from year one. In year one, you will write here very first value, you will write here present values. Okay, present value. So total present values was, if you will just go back and check, present value was 920,146. You will multiply with the 8%. This will give you interest expense, which you will record in the income statement. But actually you are paying interest at as per stated rate, which is 60,000, because face value was 1 million multiplied by stated rate, which is 6%. So this will give you 60,000. So difference of interest expense and cash payments is amount is the discount amortization. Okay. Now you have a beginning carrying value is 920,164 plus discount amortized. This will be equal to ending carrying value. So this ending will become beginning for next times 8% again. You will get interest expense. Actual interest payments are 60,000. The difference of interest expense and actual payments of interest is your amortization of discount. So again, beginning carrying value, which is 933,758 plus amortization of discount. This is how it will be equal to the ending carrying value. Okay, at the end of second year. Again, this will become the beginning for third. Again, same, you will repeat the process 8%. You will get, this is the interest expense, this is the actual interest payments. Difference of these two, you will get amortization of discount, beginning plus amortization of discount equal to ending carrying value. Okay, then this will be again beginning for next, and you will repeat this process for year 4 and year 5. You can look at here at the end of year 5, your bonds value will return to the face value, and this is the value which you will repay to the investor. Now here, We need to understand what entries you will pass and how we can present in the financial statement. Okay. So in the first year, because we are gonna to record the interest expense also, we are also gonna to record amortization of discount, and we are also going to record cash payment. So what the entry you will pass in first year, you will make debit interest expense with 73,624. By the way, you will use this value here. Okay. Then credit discounts on bonds payable, because this is the with the amount of discount amortized. Okay, so you will credit because in the first entry discount was debit. Now you will make credit every year, so it will remove over the years. Okay, from the balance sheet you can remove over the years. Credit will go to cash with the actual payment. So in short, these three columns you will use every year to record the entry: interest expense, cash paid, and discount amortized. Debit interest expense, credit cash, and credit amortization are the discount and bonds payable every year. Okay, you will pass the same entry. Okay, so here we go. So in same way, in second year, you will also make debit interest expense with interest expense, credit discount and bonds payable, because in second year we have amortized 14,704. Okay, credit cash, which is 60,000. So this is how you will do over the years. Now, to solve the exam questions, maybe if examiner is asking you what amount of interest should be reported in the income statement, so you can simply uh, give the answer without any presentation format. So you will say, oh, these are the amounts which will be recorded as an expense in the income statement. Okay. Second question, maybe examiner will ask you, what is the amount of discount amortized? You will say, here is the answer in this column. Third question, he might ask you, what is the amount of liability which should be presented in the balance sheet? Here is the answer. So at the end of the first year, this is the liability. At the end of second year, this is the liability. Third year, this one. Fourth year, this one. And fifth year, this will be liability. And then you will repay. Okay. To solve the exam question, it's really easy. But when it comes to the presentation style, if you want to present, so how you need to do it, please focus with me. This is how you will do it. Uh, we have here balance sheet presentation. Here we have a balance sheet presentation. So first we need to write total face value of bond, which is 1 million. Add unamortized premium, because this is we are not going to discuss today. So we have already covered in the previous video. Less unamortized discount. How you will calculate the amount of unamortized discount? So you need a value of discount, which was 79,854. You can just confirm in the initial recognition entry. So there is the discount value of 79,854. This is the value of discount. Okay. Minus accumulated amortization in the first, because we are sitting in the first year, so the total amortization of the first year is 13,612. You can confirm from the table here. Look in the table, we have here 13,000 here, 612. Okay, so this you will subtract as accumulated amortization, so you will get unamortized discount. Okay, so now face value minus unamortized discount. This is how you will get the carrying value of the bond, because I'm not going to amortize that issue cost in this video. Okay, so this is how you will get carrying value of the bonds, and carrying value bond is 933,754 in the first year. Just confirm from the table also, so you can look at here. Here is the carrying value, 933,754. Okay, then this is how you will present in balance sheet. Then in income statement, what you need to do here, you will take interest paid at stated rate, which was 60,000 every year, which you are paying, less amortization of premium. We are not dealing with it in this video. Add amortization of discount. Yes, in the first year you have amortized discounts of 13,612. You can just check from the table. Here we go. Here we have amortization of discount 13,612. Okay, so this you will include in the finance cost. Okay, so it will be equal to automatically 60,000 plus amortization of discount. it will be equal to interest expense at effective rate. So if you are sitting in year two, what you should do, please there you should make a note. So you will take a discount of amount is the same, but accumulated amortization, you have to select amortization for 2 years because you are sitting in the 2 years, okay, in the second years, I mean to say. So if you are sitting in year three, again, you will take amount of discount minus accumulated amortization of 3 years, year one, two, and three. Okay. So this is how you will deal with the discount. So this is called effective interest method. I hope this idea is simple for you. If you really like the video, don't forget subscribe to the channel. See you in the next video. Thank you so much. Bye bye.